Welcome to TalkTickers. We're the ones who sift through the earnings calls so you get the crucial bits.
That's right. No fluff, just the key takeaways.
And today we are diving deep into 3D Systems' first quarter 2025 earnings call.
Yep. Our mission, as always, is to pull out the essential information, figure out what it means for the company's performance, and understand their outlook.
Okay, so let's get straight into the results. What did the snapshot for Q1 look like?
Well, the top line, consolidated revenues, landed at $95 million.
Okay, and how does that compare?
That's actually an 8% decline compared to the same time last year.
Okay. Not great. What drove that?
It's a bit mixed. They actually saw some growth in services and hardware systems, but the problem was that growth got completely offset by a pretty steep drop in their materials sales.
Materials. Okay. And breaking it down by segment.
Sure. So industrial solutions, that brought in $53 million, which again was down 7%. And the driver there was mostly that materials decline we mentioned.
But they did have some bright spots in industrial.
Yeah, they pointed specifically to growth in printer sales, especially into the aerospace and defense sectors. So some resilience there.
Got it. And the other side, healthcare solutions.
Healthcare revenue was $41 million. That was a decrease of 9%. Similar story here. Really, services grew, but it couldn't make up for, again, declining material sales, and printer sales were basically flat.
Okay, so overall declines, but were there any specific areas within those segments that did well?
Yes, definitely. They highlighted personalized healthcare, which grew revenue by 18% year over year.
18%, wow.
And also their parts manufacturing business, that grew 17%. So, really strong double-digit growth in those specific niches. They definitely stood out.
Okay. What about profitability, gross margin?
The non-GAAP gross profit margin came in at 35%. That's down from 40% in the prior year, so a noticeable dip there.
Right, but they've been talking about cost cuts.
Yeah.
Did that show up in operating expenses?
It did. Non-GAAP operating expense was $61.6 million. And that is a $5 million improvement compared to last year. They specifically credited their cost initiatives for that drop.
Good to see progress there.
Yeah.
But how did that translate further down? Adjusted EBITDA.
Still negative, unfortunately. Adjusted EBITDA was reported at minus $23.9 million for the quarter.
Oof. And the bottom line, loss per share.
The non-GAAP loss per share was 21 cents. That's wider than the 17-cent loss they posted in the same quarter last year.
Okay, so yeah, the snapshot is, well, it's challenging. Declines pretty much across the board, widening loss, negative EBITDA despite cost efforts.
The numbers definitely paint a picture of a difficult operating environment right now.
So here's the thing that seems confusing. Management spent time talking about how 3D printing is this, quote, unstoppable trend, right? Mm-hmm. How it's creating new ways to manufacture, cutting costs, lead times, fixing supply chain risks. They mentioned COVID, tariffs.
Yeah, all the big benefit.
But then sales are weak, down 8%. So what gives? Why the disconnect?
Yeah, it's a fair question. And according to management, the simple answer, or maybe not so simple, is that customer capital spending, CapEx, buying the big ticket printers, it's, and this is their phrase, virtually frozen.
Frozen. Why?
Uncertainty, specifically uncertainty around tariffs. That was the main reason they cited. Businesses are just hesitant to make big investments until they see how all that trade stuff shakes out.
Okay. So it's the macro picture. The tariff cloud hanging over everything, making companies hit pause on buying new gear.
Pretty much. They did point out exceptions, though. Personalized healthcare, defense applications, and some specific bits of AI infrastructure build-out seem to be less affected by this freeze.
Right, the more specialized or critical areas.
Yeah.
Okay, so that explains the why. Given this freeze, what's 3D Systems doing about it? What's their strategic play here?
Well, they seem to be holding firm on their long-term plan. They mentioned resisting pressure to slash R&D budgets, which some companies might do in a downturn. They've been on this 3-year journey, apparently, to totally refresh their polymer and metal product lines, and they're keeping R&D spending high, like over 20% of revenue, to see that through.
Okay.
They also noted that their plan to insource more of their manufacturing is almost complete. That probably helps with supply chain control, too.
That tech refresh sounds huge,
Wow.
refreshing all the polymer and metal lines.
Yeah, it covers everything, all 5 main polymer platforms, and crucially, their entire metal printing platform. They're now actually commercializing what they call their Generation 2 metal printing systems.
Gen 2 metal. Okay, where are they aiming those systems? Which markets?
They're targeting markets that need really high performance and reliability. So think aerospace and defense, oil and gas, and also applications inside the human body, like medical implants.
Right, demanding applications.
Exactly. The idea is these are areas where the tech advantages really matter, and maybe demand isn't quite so tied to the general economy.
And it sounded like their strategy is more than just selling printers. They talked about offering like unique capabilities, a different kind of business model.
Yes, this was really interesting. Obviously, they sell the systems, but they also really emphasize providing top-notch application support through their Application Innovation Group, or AIG.
IAG, right.
And here's the key part, especially now with CapEx frozen. They have the capability to actually produce limited runs of parts for customers in their own factories.
Oh, like a service bureau model.
Kind of, but they frame it more as a bridge. So the AIG works with the customer, develops the application, prints test parts. But if the customer says, look, I need these parts now, but I just can't buy a printer because of budget freezes.
Then 3D Systems can make the initial batches themselves.
Exactly. They mentioned having facilities in the US, Europe, even a joint venture in Saudi Arabia. They said this model is something they've already proven works well in healthcare, making things like titanium spinal implants for years. Now they're applying that same idea to these high reliability industrial markets.
That makes a lot of sense as a way to keep customers engaged and maybe convert them later when budgets unfreeze.
Yeah, it keeps the relationship going, proves the value, and generates some revenue in the meantime. They also mention needing both polymer and metal solutions to really scale effectively.
Okay. And alongside this, they're also hitting costs harder. You mentioned the $5 million savings in Q1, but there's more planned.
Yes. So they already had a plan in place, announced previously, to get over $50 million in annualized cost savings over 6 quarters. That was focused on things like consolidating their physical footprint, streamlining back office stuff.
That's on track.
Still on track, they said. Should be done by mid-2026. But given the softer demand they saw in Q1, they announced new incremental actions.
Okay, more cuts.
Yeah, focused on aligning their organizational structure better with the current lower demand. These new steps are expected to save roughly another $20 million, specifically in 2025.
So adding that to the previous plan, that's at least $70 million in total cost savings they're targeting.
That's the number, at least $70 million. And they were very clear about the goal. Get to positive adjusted EBITDA as quickly as possible, then positive operating cash flow, then free cash flow.
And they think they can do that even at current sales levels.
Management stated they believe it's attainable, yes, once these cost programs are fully implemented. That's a pretty strong statement about efficiency focus.
Okay, efficiency is one side.
Yeah.
Where do they see growth coming from, even now? What initiatives did they highlight?
Dentistry was a major focus. They talked about a total addressable market just in the U.S. of over $1 billion.
Wow. How'd they break that down?
Into 4 buckets: straighten, protect, repair, and replace.
Okay. And they play in all of those.
Pretty much. Their NextDent materials are key, especially for things like dental models, surgical guides. That's kind of the repair bucket. They had a record Q4 for materials last year, though Q1 was softer, maybe some inventory adjustments there.
And straighten. Aligners.
Yep. Aligners are huge for them. It includes their single biggest contract ever, apparently providing revenue for decades. But it also makes things volatile quarter to quarter because it depends heavily on that one large customer's inventory levels and, just-in-time needs.
Got it. What about replace, like dentures?
Ah, yes. This is where they highlighted a really big new potential growth driver. They're launching a system called the NextDent 300. It's a jetting system designed specifically to print monolithic or one-piece dentures.
A dedicated denture printer.
Exactly. It's already FDA approved. Beta testing sounds positive, and they expect to launch it commercially this summer.
And the market for that?
Huge, apparently. They estimate it addresses a $400 million plus market in the U.S. alone, which they see as largely untapped by 3D printing right now. And they expect EU certification next year. So this could be a really significant new thing for them.
Interesting. Okay, moving from dental to the industrial side, they mentioned hardware and service growth there despite the overall decline. What's driving that?
Right. That Application Innovation Group, the AIG, came up again. They specifically credited the AIG with helping drive double-digit revenue growth for their metal printing platforms in Q1.
Ah, so the AIG model is actually delivering metal system sales even now.
Seems like it. It goes back to that process, working with customers, qualifying the application, maybe printing initial parts. It seems to be enabling hardware sales, even in this tough CapEx climate, at least in metals.
Which metal printer specifically?
They spotlighted the DMP 350, a triple laser system, said it's in full production now. Key features are apparently very high part quality, super low oxygen levels during printing less than 25 parts per million, which is critical for some materials.
How do they achieve that low oxygen?
It uses a vacuum chamber design, which also helps reduce the amount of argon gas needed. They also mention it has a removable print module for faster turnaround. And again, the focus markets are defense, aerospace, AI infrastructure, those more resilient areas.
Any other metal systems coming?
They mentioned a bigger one, the DMP 500 Gen 2, is getting close to full commercial production as well.
Okay. And the other big growth area you mentioned earlier was personalized healthcare and medical parts. Those had really strong numbers, 18% and 17% growth.
Absolutely. Management emphasized these are core strategic pillars. They work directly with medical device companies, basically from an idea all the way to manufacturing implants and surgical instruments.
And they can scale that.
Yeah, they highlighted their ISO 13485 certified factories, which is the standard for medical device manufacturing. That certification lets them produce these parts at scale.
And the personalized part means patient-specific.
Exactly. Using their software for planning and design to create implants or guides tailored perfectly to an individual patient's anatomy. They gave a really cool example. They recently enabled the world's first facial implant to be manufactured right there in the hospital at the point of care using their solution.
Wow. That's pretty cutting edge.
Yeah, and they're looking to expand that capability to other parts of the body and into more regions globally. They've already served nearly 250,000 patients with these kinds of solutions.
Okay, so lots going on strategically, but one, maybe less positive piece of news was their decision to pull their 2025 financial guidance. Why now?
Yeah, that was significant. Management basically said it was due to the ongoing economic and geopolitical instability, but critically, the rapidly shifting tariff landscape. That tariff uncertainty is directly hitting customer CapEx decisions, making forecasting incredibly difficult.
So given the soft Q1 start, which they blamed on that CapEx pause.
Right. They felt withdrawing guidance was the most conservative and prudent thing to do. They just don't have enough visibility into when customers will start spending again.
And pulling guidance lets them focus on.
Exactly what we discussed earlier. Hitting those cost reduction targets to become profitable at current revenue levels. It removes the pressure of chasing potentially unrealistic revenue targets in such a volatile environment.
Okay. On a more positive financial note, though, they closed a big divestiture recently, right?
Yes, the sale of their Geomagic software business, that officially closed on April 1st.
And the impact.
Big impact on cash. It brought in over $100 million in net proceeds straight onto the balance sheet.
So how does their cash position look now? They were burning cash operationally in Q1.
Right. They ended Q1 with $135 million in cash. That was down from the end of 2024, partly due to operations, but also included about $10 million in things like accelerated inventory payments and facility closure costs, sort of non-recurring stuff.
But post-Geomagic sale.
That's the key. They said their global cash balance more recently jumped up to approximately $250 million.
Okay, $250 million, that's a much healthier position. What about their debt? They have those convertible notes coming due.
Correct. Those notes are due November 2026, so about 18 months out. With the Geomagic cash, they are now in a net cash positive position relative to that debt.
So what are they planning to do about the debt?
They said they're actively looking at the options. Paying it off is one possibility. Refinancing is another, though they acknowledged interest rates would likely be higher now. Having the cash from Geomagic gives them significant flexibility to decide the best path forward. They're waiting for that cash to fully settle before finalizing plans.
Okay, let's zoom out a bit. For someone trying to understand the investment angle here, why does all this matter? What's the takeaway from the call?
Well, first, the Q1 results really underscore that broader theme capital spending is weak, especially in general industry, and tariffs are a big reason why. This call gives you a real-world case study of how a major additive player is dealing with that.
And their specific reaction to cost cuts, the focus on niches, pushing the new tech, that's the key strategic element.
I think so, yeah. It's their pivot. They're not just waiting for things to get better everywhere, they're aggressively cutting costs to be efficient now, while aiming their new products at specific markets, healthcare, aerospace, defense, AI infrastructure that seem less vulnerable to the general slowdown.
So the main signal from management is profitability and cash flow, even if revenue stays flat for a while.
Exactly. Survival and efficiency first. And that adaptation with the AIG offering to make parts for customers who can't buy printers yet, that's a concrete example of adjusting the business model to the current reality.
And the Geomagic sale just gives them way more financial runway to execute this.
Significantly more, yes. It strengthens the balance sheet considerably and gives them breathing room, especially concerning that upcoming debt maturity.
All right, time for our favorite speculative segment. This is where we brainstorm an outrageous but plausible trade idea based only on what we heard in the call. Think hedge fund pitch meeting. Absolutely not financial advice.
Definitely not financial advice, just a thought experiment based purely on the call's narrative.
Okay, here goes. The pitch idea. Given the stark contrast painted in the call, the virtually frozen general industrial CapEx versus specific resilient niches and catalysts consider a pairs trade, short companies heavily exposed to that broad industrial CapEx cycle while going long 3D systems.
Okay, interesting. And the rationale, straight from the call.
Two specific points they hammered home. First, the upcoming launch of the NextDent 300 denture system. That targets a large, potentially stable healthcare market, seemingly disconnected from industrial tariffs. Second, their demonstrated success through the AIG in actually growing metal platform revenue in Q1 by focusing on aerospace, defense, and AI markets they explicitly called out as less affected by the freeze.
So the bet is that these specific, maybe less correlated growth drivers can actually deliver.
That's the core idea. Combine those potential niche catalysts with their very clear, aggressive plan to slash costs, aiming for profitability even at today's lower revenues, plus the much stronger balance sheet post-Geomagic. The thesis would be, if they execute on these specific resilient areas and hit their cost targets, 3 systems could potentially outperform peers who are just waiting for a broad industrial recovery that might take longer to materialize.
It definitely ties directly into the strategic narrative management laid out on the call. Purely hypothetical, of course.
Of course. So let's wrap up this deep dive on the 3D Systems Q1 call. Clearly a tough quarter financially, driven by those big macro headwinds, tariffs, freezing up CapEx.
Yep, that was the dominant theme.
But the response seems decisive. Aggressive cost-cutting with a clear goal of profitability at current levels and a strategic focus on channeling their new tech into those higher reliability markets showing more life.
Right. The message was about navigating the storm efficiently while setting up these targeted growth engines, the AIG model, the new platforms for success in specific areas.
And just to recap those key areas to watch, that NextDent 300 denture launch coming this summer, the ongoing strength in medical implants and personalized health, and their push with the new metal printers into defense, aerospace, and AI.
And one last time, super important, this was just our analysis of the earnings call content. It is absolutely not financial advice. Do your own homework.
Couldn't say it better. Okay, here's a final provocative thought for you to chew on, building on what we heard. What if this whole tariff situation, this CapEx freeze that's hurting them now, what if it actually ends up accelerating the shift towards more localized, distributed manufacturing using 3D printing, bringing production closer to home to avoid supply chain issues? Could that ultimately benefit companies like 3D Systems, especially given their focus on insourcing production and enabling high-value applications near end users?
An interesting potential long-term consequence to consider, turning a headwind into a tailwind eventually.
Something to think about. Thanks for joining us for this deep dive on TalkTickers.